Welcome to another deep dive. Today, we're really unpacking some timeless wealth building principles, especially relevant if you're looking at, stock market investing and trading for long-term financial success. These insights might just change how you view your whole financial journey.
Yeah, and for this deep dive, we're leaning heavily on a really transformative source.
Yeah.
Tony Robbins' book, Money, Master the Game.
Ah, right.
And what's so interesting about this book, I think, is that Robbins didn't just, write down his own ideas. He actually went out and interviewed some of the absolute greatest investors of our time to kind of distill their core strategies.
Okay, so we're talking direct insights from some real heavy hitters then,
Yeah.
like Ray Dalio, Warren Buffett, Paul Tudor Jones.
Yeah, exactly. Those kinds of names.
Got it. So our mission today is pretty clear. Extract those crucial insights on building wealth, managing risk effectively, and maybe most importantly, starting to think like the top, 1% of global investors. Let's get into it.
Let's do it.
So maybe the place to start is with what Tony Robbins calls the foundational principle, this critical mindset shift. He basically says you have to stop being just a consumer and consciously start becoming an investor. Sensible, right? But the implications are huge.
They really are. And Robbins, he really emphasizes that it doesn't matter what your background is or how much you're earning right now. Those aren't the real barriers.
Okay.
What matters fundamentally is just making that decision to start. I mean, think about it. Even a small amount, say $50 a week, invested wisely and consistently. Well, that can compound into genuinely significant wealth over time.
Right.
It's the discipline, not some huge starting sum, that really builds the foundation.
And that connects directly to trading too, doesn't it? For those listening who are active traders, it means seeing every trade, every investment decision, not just as a one-off bet.
Yeah, not just speculative.
Exactly. But as a crucial piece of your larger financial picture, your ongoing journey, the main takeaway really is just begin. Start today, even if it feels small.
Absolutely. And once you've made that mindset shift, embraced being an investor, one of the really big insights from the book, and this might be counterintuitive for some, especially if you're focused purely on finding the next hot stock pick, is that asset allocation is the real key.
Ah.
How you spread your money across different types of investments.
Yeah.
That's what drives long-term success, much more than picking individual winners.
That really does shift the paradigm for a lot of people, I think. The book talks about how the ultra-wealthy, they aren't just making big bets on single stocks, right? They're carefully diversifying, spreading risk across a whole range of asset classes. So beyond just stocks and bonds, what else are we talking about? What are those other key asset classes they use?
Oh, they definitely go broader. Think commodities, real estate, various alternative investments too, things like private equity or hedge funds. And for traders listening, this is so critical. You just cannot afford to have all your wealth tied up in one high-risk area.
Makes sense.
The advice really is to consciously create separate buckets for your money. You need your trading capital, sure, but also your long-term investments and, crucially, your emergency funds.
Okay.
It really forces you to ask yourself that tough question. Do you actually have enough safe assets set aside to weather a really nasty bear market?
That's a sobering thought, isn't it? And speaking of buckets, to make that asset allocation idea more practical, Robbins lays out a pretty simple framework, this three-bucket strategy.
Yeah, it's incredibly helpful for just getting clarity and discipline. So the first bucket is the security bucket.
Okay.
This holds your lowest risk investments. Things designed purely to protect your capital. Think bonds, maybe fixed deposits.
Yeah.
Stuff that gives you peace of mind.
Got it. Safety first.
Yeah, exactly. Then you've got the growth bucket. This is where you aim for moderate to, potentially high returns. Often things like broad market index funds or maybe diversified stocks.
More potential upside, but still managed risk.
Right. And then there's the dream bucket. This is for your high-risk, high-reward stuff. It could be specific ventures or even, those big aspirational experiences you dream about, funding that round-the-world trip or starting a passion business.
Okay, that makes sense. Security, growth, dream. But here's the catch Robbins points out, right? Most traders, especially, tend to load up heavily on that dream bucket.
Oh, absolutely. It's a huge pitfall. That lure of the quick, massive win is just... Well, it's very tempting, isn't it?
Definitely.
But Robbins really emphasizes true sustainable wealth isn't built by constantly chasing those speculative dreams. It's created when your security, your growth buckets are balanced and crucially consistently funded. That provides the rock-solid foundation. It makes those dream investments actual opportunities, not just, desperate gambles. And while we're talking about protecting wealth, we often focus on market ups and downs, right? But there's something else, a kind of silent killer that consistently eats away at your wealth accumulation.
Hey, sure. What's that?
Fees. Simple as that.
Huh.
We're talking mutual fund expense ratios, broker charges, maybe advisory costs. These little percentages, they just quietly erode your returns year after year.
And the stats on this are actually quite shocking in the book, aren't they? I remember reading that a seemingly tiny 2% fee,
Yeah,
compounded over, say, 30 years, can end up costing you more than half of your potential final wealth.
it's devastating when you think about it like that. 50% just gone to fees.
Wow.
And that's why Robbins is such a strong advocate for, one, low-fee index investing,
Yeah.
but also for just demanding absolute transparency in all costs.
Right.
And for active traders listening, this is super relevant. Choosing the right platform, one with minimal transaction fees, is absolutely critical for your long-term profitability. Those small costs just add up incredibly quickly over hundreds or thousands of trades.
So it's not just about the trades themselves, but the cost of trading.
Precisely.
Okay, so moving on. What really separates the billionaire investors like, say, Ray Dalio or Paul Tudor Jones from everyone else? It can't just be secret stock tips, right?
No, definitely not.
So you mentioned Dalio's focus on radical transparency and Jones's strict risk control. What does that actually mean in practice? How does that give them an edge?
Well, it really comes down to mindset, fundamentally. For Dalio, that radical transparency isn't just a buzzword. It's about constantly stress testing your own ideas, actively seeking out disagreement.
Interesting.
It's about building systems, processes that learn from mistakes rather than, trying to hide them. And for Paul Tudor Jones, that legendary risk control. It's not just about setting a stop loss.
Okay.
It's an ironclad belief that protecting your capital is job number one, always. He famously said something like, losers make up a large percentage of my portfolio, but they're tiny losses.
Ah.
And that discipline, that willingness to cut losses while they're still small, that's where so many people fail. They let small mistakes snowball into disasters.
Right, the emotional part kicks in. And Robbins takes these kinds of insights and boils them down into, like, universal truth for all investors, doesn't he?
He does. It's about managing your emotions, getting off that fear and greed roller coaster. It's about avoiding the temptation to overtrade, to constantly be doing something.
Yeah.
And crucially, it's about thinking in probabilities, not certainties. Understanding that you're dealing with likely outcomes, not guaranteed ones. It's a big shift from hoping to strategizing.
From hope to strategy. I like that.
Now, shifting gears slightly, but it's all connected to this long-term view.
Yeah.
The ultimate goal, really, of investing and trading shouldn't just be about accumulating money.
Okay.
It should be about achieving genuine financial freedom. And often, the most sustainable path to that freedom is by building passive income streams, income that comes in whether you're actively working or not.
Right, the dream everyone talks about. So what are some concrete examples of that? We talking dividends?
Yeah, dividends from stocks are a classic example.
Right.
Rental income from property is another big one. You can set up bond ladders where bonds mature at different times, providing steady cash flow, royalties, maybe from creative work, or even monetizing content you create online. There are quite a few avenues.
It's interesting. I think many people, especially traders, get so focused on the active part, the daily profits.
The P&L.
Yeah, the P&L, that they completely overlook setting up these longer-term passive streams. It's like playing checkers when you should be playing chess.
That's a great analogy. And it's a really common oversight. Traders get tunnel vision on the short-term returns, the thrill of the trade,
Understandable.
and they forget about building that foundation for the future, that income that keeps flowing regardless. So yeah, this deep dive is definitely a reminder to try and do both.
Okay, so let's make this really concrete for everyone listening. How about an action plan, steps people can take inspired by these principles?
Perfect. Let's nail it down. First step, automate. Set up monthly systematic investment plans, or SEPs, just regular fixed amounts going into low-cost index funds. Takes the emotion right out of it.
Okay, automate index funds. Got it.
Second, create your 3 buckets. Actually define them. Security, growth, dream, and then, crucially, audit them. Check in every quarter. Make sure they're balanced how you want them.
Right, review regularly. Makes sense.
Third, specifically for trading, implement strict loss limits. Cap your loss on any single trade to, say, 1–2% of your total trading capital.
Non-negotiable.
Discipline on losses. Key.
Fourth, continuous learning. Make it a goal to study one legendary investor, read their biography, understand their philosophy every single month.
Learn from the best. Good one.
And finally, number 5, commit to passive income. Build, or at the very least plan, at least one new passive income source within the next year. Start small if you need to, but start.
Okay, that's a solid 5-step plan. Automate, bucket, and audit, cap losses, learn constantly, and build passive income.
Exactly.
And it's important to remember, right? These might seem like small steps individually, but done consistently, that's where the real power lies. They build significant long-term results through compounding. Absolutely. It's not about hitting home runs every day. It's about consistent base hits over a long period.
So maybe a final thought to leave people with, based on all this?
Yeah. I think it's this. Mastering money, truly mastering the game, is actually less about chasing the next hot tip or the next big trade.
Okay.
And much more about building robust systems, cultivating disciplined habits, and holding on to a really clear, compelling vision for your own financial future. It's about the architecture, not just the individual bricks.
Build systems, habits, and vision. That's powerful. And I guess the ultimate message underlying all of this is, let your money serve your life.
Exactly.
Not the other way around. Definitely something to reflect on.